The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and thank you very much for being with us today, this evening. It's good morning to our friends in the great land down under, and it's good afternoon to those across the ditch in New Zealand. How are we going for sound? Kevin and Mark's on here. Everyone hear me all right? Sound is good? Yes, says Mark. Good. All right. Thank you, guys. It's good to have that. Look, boy, the Chinese have that saying, may you live in interesting times. And I mean, what a gift we're getting from the volatility. I mean, it's just fantastic. But it also brings some problems with it. So we're going to talk about that today and much else as well. So let's just see who's here with us. We've got a big roll-up today. Lovely to have all our regulars here. Albert Z, time for another tutorial for you, my friend. Bob, Carol, good to have you with us. We don't have a lot of ladies, and we love to have ladies. So welcome to you especially. And we've got another Carol. Goodness, we've got two Carols. Chase, how are you, my friend? I'm still smoking those cigarettes, but trying hard, getting there, I think. Fiona, another lady. 3 ladies today. That's a record. Harold, over there in Reading. Hello, my friend. Stay with us. We've got something on gold, but it's towards the end of the program. I know you'll want to see that. And it's probably good news for gold people, gold bugs like Harold. Jeff, he's a tutorial guy. Good to have you with us. Terrific. Let's see. Here we are, all the regulars. Yes, thank you, Jim. Oh dear, let's see what we've got here. Yep, Igor. Good to have you with us, Igor. John Chiwa. Been with us a while. Good to have you. Justin down the Hunter Valley. Kevin over there in Minnesota. Mark, the other Mark, he's going to be a big trader. He's done a tutorial. Mark L. Terrific. Marvino, lovely to have you with us. All the regulars here. Mike Murphy, he's going to be a terrific trader. He already is a terrific trader. He's done the Daniel Code tutorial. He's sometimes sends me his results. I post them on the front page. I think he's last time we posted, he had made 8 times his where he was with his account balance. Milton, good to have you with us. Mr. Deck, he's a Pommy. Good to have you with us, Deck. Boy, we can go on forever. Rick, Steve, Scotty. And Tom, the wealth manager. And Trevor, Tom's a wealth manager in Florida. Okay, folks, let's move on because we've got tons and tons to talk about today. Let's have a look. So I'm going to show you some of the good news as we move through this, but I thought we'd better start by being realistic and giving you the bad news. Forex had a shocker today. 10 out of the 15 markets we cover, we didn't have signals in them all, thank goodness. We did have a buy signal for this market, which is the Aussie US dollar pair. Big gap up, $360-odd gap up. And then failed. And that's what happened in 10 of the Forex markets. Pretty unusual. I know Draghi was speaking. I know people get terribly excited. Marvino, yes, thank you, my friend. Greetings to you too. Deck, all fantastically well here, even better when we get some volatility, as you know. So volatility's infected the Forex markets. There's a whole lot of people, day traders, who are just hanging on every word of the central banks from here, there, and everywhere. The reality is that very, very rarely do they ever matter long term, but you can get these short term gaps. So if you're concerned about this stuff, remember your protective stop. If you were short this market, your protective stop has to be on stop. In other words, you must be stopped out. If it gaps past where your entry order is, that's a different thing. But your stop loss must always be in the market. There's nothing to say that this market couldn't gap 360 and then run up the top of the page. So your stop loss must always be on stop, your protective stop, and it must always be in the market. If you want to filter your new entry by using a stop limit order, which means that it becomes a market order when you reach trades at your stop, but it has to be filled before it gets to your limit. If you want to do that with a new entry, that's fine. but make the distinction. Your stop loss, your protective stop loss of your existing position must always be in the market. And if it gaps and you get a lousy fill, that's part of the price of doing business. Thankfully, it doesn't happen very often, but it's really interesting to see how volatility in the equities has really excited the Forex market. So I wanted to tell you that, make sure you understand the way to handle those, and now move on as to what's happening with these most interesting markets. This is the S&P index, and I wanted to tell you something before I got onto this about learning to write backwards. Da Vinci was not only a famous artist, that would be Leonardo da Vinci, he was also an amazing inventor of war machines. And in his sketches, he's designed all sorts of warlike tools, implements, machines, most of which probably nearly all of which they didn't have the technology to build back in his day, but in between painting the Mona Lisa, he designed implements of war. And Da Vinci had a particular trick. He was so concerned that people would copy his notes. You see, he didn't have a computer then. He was writing everything down on parchment. He was so concerned that people would crib his notes and copy what he was thinking about and doing about, that he taught himself to write backwards. In other words, for law, instead of putting LAW, as you see on this page, he'd put WAL. And what I've been telling some of my tutorial clients, Mick in particular, who'll probably watch this later, is learn to write backwards, because it's a wonderful gift for you. Because once you've mastered that art, you can go and get a piece of sticky tape and you can write on it, "I do not know what markets will do tomorrow." And if you write that backwards and stick it on your forehead, every time you look in the mirror, you're going to read, "I do not know what markets will do tomorrow." And that's a terribly important thing for traders to realize. I don't know what markets will do tomorrow. If I don't know, probably no one does. But the reality is, all we can do is we can see the river of our life backwards. We can only look at what's happened in the past. Only God has the ability to see the river both forwards and backwards. We're not blessed with foreknowledge. We do not know what markets will do tomorrow. So we must always be prepared for the unexpected, and we certainly got a bit of that this week. This is the 6-day chart. Let's start with the longer term stuff. And you can see that in the January high, it's interesting to look at these charts because these are not linear charts, these are angular charts. And you can see that the darker blue line in the middle, that's the median, and the ones running up and down are one standard deviation from the mean. For those of you who are trying to emulate this, they're not normal mathematical standard deviations, they're Daniel Code standard deviations. So in January, we saw the market on this chart peak out at 4 standard deviations from the mean. 1, 2, 3, I'm sorry, that's 3 standard deviations from the mean, almost perfectly. It then went down, and then it rallied to make its final high, or what at the moment it's the final high here. But look what's happened with Newton's law. Newton's law says, one of his laws says, every action has an equal and opposite reaction. So I've told you at various times in the past, if you see these markets go to 2, 3, 4 standard deviations, I've got 4 standard deviations on here. It's not. It's 3 standard deviations. Forgive me, I was thinking about the NASDAQ, which is at 4 standard deviations. Then the minimum move you can expect, according to Newton's law, is 3 standard deviations the other way. And that's exactly what's happened here. And that's interesting because these markets, these major markets, are approaching very, very important inflection points. This one of the ladies that's doing a tutorial with me, Suhasini, out in, I'm going to say Montana, and I might be wrong, but she is heavily invested in the stock market, and she was very worried about, what about my 401k? Well, this is the NASDAQ. which has been providing all the puff. Something like 40% of this last major rally in the broader equities, the S&P, has come from tech-type stocks. It's been extraordinary, and this is the one that's gone to 4 standard deviations from the mean. 1, 2, 3, 4. You can count the lighter blue lines, and this market topped out almost exactly, as close as you can look at, to the extension of 4 standard deviations from the mean. And what's extraordinary about that is I've actually stopped this Daniel Code channel back in January. And since then it's been on its own, and it's picked that high perfectly, which is also a 4th seal high and a 5th seal high as well. And that is 4 standard deviations from the mean. So if Newton's law holds for the NASDAQ the way it has for the S&P, have a look where 4 standard deviations below the mean is. It's down around 4,700. And that's pretty exciting stuff. So excuse me if you're not into falling markets, but if you're a futures trader, you just love volatility. We get paid exactly the same when markets are going down as to when they're going up. So I'm equally excited about the markets going down. In fact, a little more excited, because the old saying is markets go up by the stairs and down by the elevator, meaning once they start going down, they tend to go down more quickly. So just thought you'd be very interested to see that. Try and keep in perspective that if this market is to get down towards the 4,700 mark, there'll certainly be all sorts of drama going on, and I'd make sure all the windows on upper buildings around Wall Street are well locked. But that wouldn't simply be a normal result of Newton's law. So this is not something that happens all the time. Of course, it does in the physical world. Markets are more a psychological world than the physical world, but it's something to bear in mind. That would be a reasonable target for NASDAQ to get down to. So Suhasini's question about what about my 401? When do I start to panic about my stocks holding? Well, markets don't necessarily repeat, but they do rhyme. So let's have a look here at the... Sue, you've arrived. I've just been talking about you. This is your question of what about my 401? When's the time to panic? And I said, well, you're going to need, not yet, you're going to need some big moves down in the NASDAQ until before you see any real possibility of a total failure in this market, which is going to be really interesting because the U.S. economy is incredibly strong. So are most of the developed world economies. They're all pretty good. Some, like the U.S., are very good. But, of course, they also have problems, which can turn nasty very quickly, which is what's going to lead us into considering what's going to happen with the U.S. dollar. But basically, Sue, here's the 2007 top in the S&P. And you can see before you could really even start to think that the whole of that bull market was over, you needed a close below one of these 6-day bars. So these are 6-day bars. Remember, folks, every bar is made up of 6 trading days. So that's what happened in the S&P, and this is what happened in the NASDAQ, much the same. You needed a close below a swing on the 6-day chart before it was time to panic, and even then the market rallied up well past that point. You had plenty of opportunity to play the downside, but we're not at that stage yet, and that's the absolute, in my view, that's the absolute minimum you need to see before you start getting too excited about the end of the bull market. There's certainly a lot of weakness coming into it in the last few days, but one's sparrow does not a summer make, and we just have to wait to see what unwinds. And, of course, waiting to see what unwinds is not a chore, it's a pleasure, it's a delight. If there's volatility, nothing will spark up your life more than volatility in markets, and we have, great volatility now. Okay, so that's the answer for you, Sue. So let's have a look how these markets have been tracking, and watch this sequence as markets rhyme. They don't necessarily repeat, but they do rhyme. So this is a standard Daniel Code tool that gives us the major time cycles. which are 44, that's the dominant cycle for gold, 59, which is traditionally gives us tops, and 62, which traditionally gives us lows, and 70, which we call the heathen cycle. In fact, there's nothing heathen about it. It just means that it comes from a different part of the book of Daniel. In fact, it comes from the part that Sir Isaac Newton, the father of science, was so intrigued with. And Newton, the great scientist, actually wrote more about his Christian beliefs than he did about mathematics and physics. So it's extraordinary. One of his big papers is called Observations on the Prophecies of St. John. And you can get that. It's on the internet and it's free. It's really interesting how he uses 70 and does all the magic stuff that you are allowed to do with prophetic geometry or prophetic scripture. Some of it's not dissimilar to the work I've done to find the Daniel Code, but it's certainly worth a read. And of course, no one's going to disagree with Sir Isaac Newton, unlike plenty of people who want to disagree with John Needham, which I guess they're quite right to make that distinction. But have a look at this. Here we were from the low all the way back in the February 2016 low, and look what we got. The 44 gave us the April 17th, March 17th high, -1 bar. Now, all of these time charts are accurate to plus or minus 1 period. That's the only leeway that we allow them, and that's because the count can start from either the swing low or the chart low, and there's often a difference, or the swing high or the chart high. So in this case, you can see that this blue line at the start in February 16 started from the closing low. If we'd used the next bar, which was the actual swing low, then the 44 would have been right on that high. And then, of course, the 62 has given us the July high. So we've got the January and the July highs, both on Daniel Code time cycles. And as I've told you before, those of you who follow what we're doing here, once a time cycle has bitten, it very, very often will repeat. Now, I always tell folks, all we're dealing with markets is probabilities. Don't ever get yourself welded into a dogmatic position, because there's always a different explanation for what markets do. But for these time cycles, we're looking at finding high probability turns. And remember, these time cycles say nothing about quantum. They tell you that's a probable position for a high or a probable position for a low. They don't tell you how that big that's going to be. So you can see at the 44 cycle here, what we got was basically 1, 2, 3, 4, 6 weeks down. At the 62 cycle, what we got was 3 weeks down. Now have a look what's happened at the latest high, which I'll show you. We'll get to that. It's only 3 weeks down so far, the week being six trading days, the Daniel Code week. But the quantum is 5, 6, 8 times what it's been before. So remember, time cycles are accurate as to time, but they're blind as to quantum. So this sequence started to work from the February 16 lows. Watch what happens as we move along. Then we moved on to a very minor low before the low. Have a look at that in May 16 on a 6-day chart. A low before the low is a very, very important place to start time counts, to start fourth seals, fifth seal lines. It's a highly significant structure, a low before the low. Those of you who attended all my webinars will remember that we had the January highs in the S&P came right on a 70 Daniel Code time cycle, which started from a low before the low way back some time ago. So we've seen these time cycles bite from the February low. We move on. Our next structure we find a low before the low. That gives us a minor high on the 44, nothing on the 59, nothing worthwhile on the 62, but the 70 gives us the closing high of the January rally. The next bar is the swing high, but the 77 hits right on the closing high. So we move that on, and we get to the next low. This is just after the little low before the low, and this gives us the April low, and the time cycles are inverted. Typically, we expect the 59 to give us highs and 62 to give us lows, but they can invert, and this is one of those inversions. We got the April low on the, I've got written on there, 44 cycle. I was doing this in a hurry very, very early this morning, folks, so forgive me. I've had a bit of dyslexia here because that has actually come on the 59 cycle. There is a minor low on the 44, but the important April low came in the 59 cycle. So what happens if we keep moving this along and finding the lows? Here's the next little low. Look what this has given us. It's given us the high at that bar on the 62. It's given us actually the high. No problem. It's exactly the same thing as we've been doing all the way from February 2015. We've just been moving this along to plot any low as a starting point, and that's given us, and we knew that these cycles had inverted, and this time at the high, the 62 has given us the high, which is an inversion to our typical expectation that the 59 will give us a high. And there's a bit of good luck with that because, as you may know, if you've been staying with us long enough to go back to 2008-9, the 2007 high, the crash high, came at Daniel Code 59 cycle, high to high on the first hop. That's the crash cycle. It's not apparent in this market here. Okay, we don't have a valid crash cycle at work, so probabilities are we get a good pullback. It's all welcome, and it may well be because this economy is so strong, but there's also significant failings in the fundamentals of some of these markets reporting because everyone got a bit excited, the market's got a bit ahead of itself. You could just get a consolidation. Doesn't mean that high is a high because that's a 62 high. Doesn't mean that's the end of the bull market. In fact, we need more evidence before we can make that call. As I've shown you a bit earlier here today, that we need a longer term. We need a close, but at least below a important swing low on the 6-day chart. That doesn't mean that we can't get bearish. We're bearish and bullish every day. We can trade this thing the way it goes, but there's the time cycles, and I thought you'd be intrigued, as I was, to just see how accurate they've been. It's really quite extraordinary how markets do that. In this chart, I'll just make sure it's changed for you. Let me go to my audience view. Yes, it has. This is the power of time. I put 2 time cycles on here so you can see that you got the January highs and the September highs all happening plus or minus 1 period, simply enough on 2 time cycles. And in the last slide I showed you that you had a 62. This high on this particular second cycle came, the final high that we've seen so far is on the 44 period, and it's 1 bar early. That's consistent with we allow these signals to be plus or minus 1 bar, no more. And you can see the reason for that. It's because from where we start the count, it's valid to start from a swing low or the closing low. And that's why we allow a variation of plus or minus 1 period. And it's extraordinary, isn't it, the way these markets just react to time continually. Okay, what have we got here? Let's see. Right, let's move on. This is the 6S, which we've had running on the market on the website now for about, I'm going to say 2 months. My guess is it is at least 2 months, and it's been free because we haven't got it bedded down and working exactly the way we want it yet. But it's been extraordinary. So these are it's all free. You just have to be You just have to log in. Just if you're not already a member, just register. We just need your username and email address, and you'll get a password. You can log in every day and look at the success signals, and they'll be free for a little time yet. Eventually, we're going to put them on to a leader-follower program, and hopefully that's not too far away. So we look at these signals. Well, they're perfectly perfect. All the sells have come when they needed to, and the buys have come when they needed to. And in fact, this market's been technically perfect all the way down in terms of signals. We haven't missed a beat. The success signals have been absolutely perfect. But what do you do when risk is elevated? At the bottom of this chart, which I think has changed for you now, you can see a blue line, which is the average true range. This is a really short-term one. This is only over 3 periods to show you just what's happened with this average true range. And of course, once you start dealing with volatility, your stops management becomes absolutely crucial. So here's the same thing happening. It's still perfectly perfect, but what do we do with the stops when we get these massive big ranges? So let's have a look at a particular issue we had here during the week, and I want you to focus on, this is the S&P E-mini. Excuse me, focus on the box that's got the little red outline around it, which I think that's October the 22nd. And to get the next signal from that, you had to make a determination of trend. Now, those 2 red lines on there, they're just merely a trend line at the high duplicated and hung off the bottom of the low. That's not a particularly sophisticated way to be determining trend. We have other tools that are far more exact. But this is a basic one, and there was real ambiguity about what was the trend on October the 22nd, depending on your time frame. If you're a short-term trader, you said, oh, well, crikey, the trend's already been down for 3 days. What are you talking about? Understand that. But for the analysis from daily charts, we do it a bit differently. So there was real ambiguity about that. We've been against the major trend for a couple of days on the daily chart. Peter, I know, will jump up very soon and say, no, the short-term chart's been down for days. I get that, but that's not what we're trading. So with that ambiguity, we've been taking sell signals in what was primarily been an uptrend, which means we've been using a trailing stop equal to about 59% of an average daily bar. And we got stopped out on the 22nd. We're flat, and what do we do the next day? Well, what's the trend? If the trend is up, then the sell order is going to be a counter trend, and you're going to be a little bit more aggressive on your stop if you think you're taking a trade against the trend. If the trend is already down, then you're going to use a 1-bar counter trend, 1-bar stop, and it's going to go down. You're going to get really excited, and when you look at it after the market's closed, you're going to say a rude word because it's just rallied all the way back to the last bar's low. So you might even say 2 rude words, and then of course it continues this little plunge down yesterday. So have a look at this. This is a 60-minute chart, and so we're still looking at that same period, 1022. If the trend is up, which I said it was at that stage, but very ambiguous, you could equally have said it was down. On balance, I said it was up. Then we're aggressive with our stops, and what I did here in our success signals is I used a $650 odd trailing stop. In other words, the stop moves down with the market, and it stops you out when it rallies 650. I couldn't get this tool to show exactly 650. It's showing 675, the rally where we got stopped out. Now, that gave you a profit of $1,200, and the big rally back didn't worry you. So that worked fairly well there. But let's move on. What happens then? So that was the Tuesday. By Wednesday, after that big bar, even though it's rallied and closed up closer to its high than its low, the trend is definitely down. So if you're going to sell that low, you should use a 1 bar stop. But, lots of buts about it. Look at the size of these bars. Okay, so let's look at that in more detail. Here's the side that says but. That's exactly what you should be saying to yourself. But if you're going to sell that low and use a standard 1 bar stop, your risk on entry is almost $3,500, which is about 3 times the average daily range of the S&P. Now, by average daily range, I don't mean these periods when you get a big bunch of volatility. Think of your trading as a continuous stream that goes on forever. Within reason, and not to be pedantic by any means, but just with a broad brush, you want to have the risk on each trade approximately equal, because the percentage win and loss is going to be pretty much the same through any period of the chart. Okay, so think about if you're using a progressive staking system in cards or baccarat or horse racing, whatever your poison is. You want to try and keep the size of your bets roughly equal. Otherwise, instead of being an investor, you become a gambler, and you're just taking a punt on that particular trade working. But the problem is that particular trade, if you don't get it right, can wipe you out. So for this situation here, on the Thursday, the trend was certainly down, and the correct entry was 2 ticks below the low if you weren't already short. But where do you put your stop? You couldn't put your stop 2 ticks above the high, because that's $3,460 odd away, and that's 3 times the average daily bar. So what you should do, although that's the technically correct answer, the reality is that preserving capital is the #1 rule for everything you do. And here we saw the same thing. It was a bit worse in the NASDAQ. It wasn't much damage in the S&P, in fact, none at all, because we used a discretionary trailing stop in the S&P on our success signals, and we got stopped out in the little rally from the low, but we made money. We were happy with that. This is the NASDAQ, and you can see this was a bit of a shocker. We had a time buy signal, which was elected, and no sooner had it got elected than it turned around and started to dive. Well, where's your stop? Same thing here. If your stop's below the swing low, that's a risk of $4,700, which is impossible. Once volatility starts to expand, you should be using no more than the equivalent of the average daily range of 1 bar. And I don't mean the average daily range when volatility's built up. I mean the average daily range before volatility is built up. And if you're looking at that on a chart, you're not too interested in the bars that are very close to turns, because markets tend to accelerate into and out of turns. The bars get a bit bigger. But you must have that catastrophe stop at all times, and that stop really should never be very much bigger than one of the average daily bars range, which in the S&P is about 1100. Okay, let's see what else we've got here. Let's move on. And yeah, this is just what I was talking about. I expanded the average true range now to 90 daily bars to show you how that moves around, and it's very much weighted by the big bars. One of the problems that happens is that when you're doing a really long-term calculation on volatility, which is the way the exchanges calculate margin, the big bars are heavily overweighted. So the problem with the S&P is it was moseying along nicely, doing its up, not too far down, up again, all the time until that January volatility hit. And the margin went from 3,600, somewhere around there, to over $6,000. And because of this tendency of the large bars to have higher weight, it hasn't come down. And in fact, in the S&P, just hold 1 second. In fact, in the S&P, it's still doing average daily bars. Just ignore what's happened in this exciting rundown with volatility. It's still doing average daily bars of around $1,100. You see the three I've just highlighted here. One was 1,030, one was 1,300, one was 1,100. So you can say 1,100 or 1,200 is an average daily bar. But the margin hasn't come down. The margin's still $6,000 plus. In other words, for trading purposes, the S&P's become a real problem. It's trading with its normal volatility, but the explosion of volatility in January has pushed the margin out so high that it hasn't really been a great trading proposition since then. And I can tell you, my well-informed spies tell me that the exchange is equally worried about this, and they're trying to think of a way to bring out a new smaller S&P contract, smaller in terms of the margin. That margin's too much for a lot of people. So there's the problem that when volatility explodes, don't get sucked in to using a bigger stop and a bigger stop. You want to have the risk on each entry somewhere near about the same. I'm not going to say equal, that's far too precise, but you don't want to be going from a $1,000, $1,100 average daily stop out to $2,000, $3,000 or $4,000. That's far too much risk. It's way outside your parameters, and it also destroys your trading bank because the win-loss percentage is still much the same. The volatility hasn't affected that, and you're as good a chance of hitting a big loser as hitting a big winner. So bear that in mind, folks. So margin is not the best measure. Have a look at this. This is still the S&P and its 6,000 odd margin, which has been ridiculous. But now that we're getting this massive volatility, the brokers are saying, phew, thank goodness we've got a big margin on this, because a lot of people are getting burnt who don't know what they're doing. But just have a look. You can see most of this is from the same chart, 83 ticks, 106, 89. They're your typical average daily bars. Look what we've got down here now, 225 ticks. So that's just how volatility has exploded. What you have to do is still maintain roughly the same risk on every trade as they go through. You don't want to be reacting to that. I wanted to just wait till this chart's changed for you and show you the gift of correlations in volatility. Now, I haven't spoken about correlations for a while, but those of you who are with us all the time know that correlations are a vital part of trading. And the most notable correlations are gold and silver, and then the US equities, including Germany's DAX. They're very highly correlated. And they're correlated to the stage that a signal in any one of them can be executed in any other, so long as the trade is elected. So you can see here the first sell signal right near the top of this chart. That was actually a signal, I think, in the Dow. But some of these have been in the Dow, some have been in the S&P, some of them have been in the Russell. They're all valid to execute in any other correlated, highly correlated market, which the equities are, so long as the trade is elected. And you can see by using a mixture of the signals we've created in Dow, S&P, NASDAQ, and the Russell, you've been with the trend all the way, long and short, absolutely perfect, made a ton of money. It's just been terrific trading there. Bear that in mind. Correlations, US equities and the DAX, Germany's DAX, are so highly correlated that a signal, a Daniel Code signal in any one of them can be executed in any other, provided the trade is elected. So bear that in mind, because there's a whole lot of goodness to come from that. Let's have a look. We're going to come back to that a bit later. Let's have a look what's happening with our Sixth Seal stuff. Wheat, a miracle of miracles, has finally broken out of its trading range. We're fortunate enough that been short with a 1 bar stop since 1, 2, 3, 4, 5, 6, 7, about 9 days now. And we've made $1,680 in wheat, which doesn't sound like a lot until you think that the margin is $1,300, and that's about 120% on margin. And any time you see that that's good trading. Doesn't get much better than that. So that's what we've been doing in the 6 Seal. It's been free. It's still free. If you want to follow it, you're most welcome. You just need to be able to log into the Daniel Code website to register. All you need is a username and make up your own password. Okay, this is soybeans. This is the other big trade in the success trades. Plus $1,800 in soybeans today at the close. Nice money, isn't it? Now, you look at the period before and you say, well, look at that. We've had a couple of up bars, 2 down, an outside bar up, an inside bar slightly higher, an outside bar down. Doesn't look good until we've had this last little breakout to the high and now this rundown. And that's typical of trading. What I say to new clients is it's a bit like offshore yacht racing, which is my particular passion. You have long periods of total and abject boredom, followed by occasional periods of riveting fear. And that's what happens in trading. Probably 70% or better, 80% of the time, you're dealing with a market that's not freewheeling. It might have a trend of up as this market had before the high, but it's up, it's got a counter trend, it's up, another counter trend, up, another counter. You have to be able to trade those markets. That sort of unarmed combat against poverty if you can't. So you must know how to trade those markets. But eventually, volatility breaks out and you get these freewheeling moves where you get 2, 3, 4, 5, 6, 7 days in a row, sometimes more without a single counter trend. And that's the gift, that's the reward. And that's basically how the success system works. It relies on being in the market almost all the time. When volatility comes into a market, the gift comes. And when there's no volatility, you battle. In fact, on all of the Daniel Code trading systems, the only time you'll ever lose money consistently is when markets are consolidating. Now, note I've used the word consistently. It's very possible, happens all the time, that you have a losing trade. And if you can say, I was correct and I lost money, that's fine. If you have to say, I was incorrect, I didn't follow the system and I lost money, that's when you need to take yourself out to the woodshed and give yourself a good thrashing. So having a losing trade is nothing, as long as you've controlled the risk and you're aware of it. That's just part of the cost of doing business. But often enough, the big moves come that reward you. That leads me philosophically to discuss the basic idea of trading. When I started off trading, I was trading the S&P. And it wasn't very long before I was trading the big S&P. I was a very, very big trader back in the day, not now. This is many years ago. And the margin of the big S&P is massive when you start talking about lots and lots of contracts. But because I was only trading one margin, I obsessed over it. If I had a bad trade or a losing trade, I was obsessive about it. I'd drive myself nuts trying to figure out why I missed a trade. That was my particular hate, still is. And when you decide, but the real problem with that attitude of just one market is that volatility is like waves. It waxes and it wanes. Volatility comes and it goes. It comes and it goes. And to my knowledge, there's no way of forecasting future volatility. And if I don't know, it's most unlikely that anyone else does. Hello, Janet. Good to see you popping up. What would I recommend for the little guys? Sugar is great. The grains are great, wheat, corn, as long as they're breaking out of that consolidation. All of those are, we've done pretty well out of wheat. I just showed you the wheat chart. Sugar's a really, really good market. Interesting, when we started covering sugar, the margin was $500. It's now over $1,000. So I guess all you Daniel Code folks have been listening to me and started trading sugar. Okay, so don't trade one market because you're just going to obsess over it. You're not going to get the benefit, because if you're just trading one market, and almost everyone who comes to me says, I trade gold and the S&P. Well, great. But there's long periods of time where gold and the S&P are not great markets to be trading. You don't want to be locked into the I only trade gold and trade S&P. Market structure is such that volatility comes and goes like a wave, and if you are stretched across markets, if you can trade 2 or better still 3 or even 4 or 5 markets, say you're trading 3 markets, the probability is that you won't be caught in a correlation or a consolidation in all of them. If you have a consolidation patch in one of those markets, probability is the other markets will be rewarding you. And that is better. Building the portfolio of markets that you're interested in is the best way to trade. It's also much better for your psyche. Okay, let's move on. So these markets, we've seen noticeable differences in them. This is the Russell, and those of you who haven't traded the Russell, this used to be traded on ICE, on the ICE exchange. They've given it up. Russell is the small cap market. It's the index that represents the stocks with the smaller, lower capitalization. It's the opposite of the Dow, if you like, which are all big caps. Russell has been, now that it's moved over to the S&P, the code is now RTY for the Russell. It used to be TF when it was on ICE. It's no longer on ICE. It's on the CME. That's made this month's contract, this front month, pretty spotty at the beginning. But this market has been considerably weaker than the other markets. The Dow, the Nasdaq's been the strongest, followed by the Dow, then the S&P. The Russell's been the weakest market. So if you're going to execute sell signals and you have the choice through market correlation, execute them in the weakest market. This is the Russell. These are the first signal I've shown on here was an S&P signal. The next was a TO3 and blue line buy that only gave us 1 day up. Immediately switched over to a sell on the Dow and the S&P. 2 days later, executed in Russell. You can see the typo there. It's not IB, it's in Russell. But if you're going to execute sell signals, it's very clever to execute them in the weakest market. If you're going to execute buy signals, it's very clever to execute them in the highest and strongest market. And you're able to do that because of the high degree of correlation between all of these equities markets. So Dow, Russell, Nasdaq, S&P, and Germany stacks are also highly correlated that a signal in one can be executed in any other. And think about that. Makes plenty of sense to me. So this is, your chart should be changing any moment. It's changed now. This shows you 2 markets together. The Nasdaq's in the top layer and the Russell is in the bottom panel. And look at the breakdown. Look at the divergence that's happening there. The Russell, the Nasdaq, is rallying all the way up into October. At the same time, the Russell's made its high back in September and it's rolling over. It's just sliding off. So that correlation there is starting to break down. And when correlations break down, good things happen because the arbitrageurs are going to be pumping like hell to try and capture the difference, the vega between them. And eventually they'll come back together in terms of dominant trend. But this gives you a nice picture of when correlations break down, good things happen, i.e. you get volatility, which is God's gift to traders, is volatility. And what I wanted to show you in particular, and who was I looking for, particularly my favorite gold bug, who I hope is still with us. Let me see. Boy, we've got a lot of people here today. Good to have you all with us, folks. Akshay suddenly arrived. That's great. Where is he? Bear with me, folks. McDougall's with us, the man who needs to learn to write backwards. I do not know what the market will do tomorrow. Mick. Okay, this is, I just can't find him on this thing, but he's a famous gold bug, lovely guy. He was very good to me when I was over in Redding, California, giving a tutorial many years ago, and he's our leading gold bug. Well, look at this. This should excite you because, as you know, gold and the US dollar index have been in an inverse correlation for a long, long time. I actually wrote an article about this many years ago. Those of you who read all of my articles, they're all available at the Daniel Code website. Under articles will know I did an analysis historically of the number of times that this inverse correlation between US dollar index and gold has broken down. And in better than 85% of those occasions, when that correlation breaks down, it's broken in gold's favor. And look, that's what's happening here. You've had this constant dollar up, gold down, dollar up, gold down, dollar down, gold up. That's been broken now recently, since very recently. These are daily charts. Dollar has rallied and gold has pretty much gone with it. And that's very important because that correlation is breaking down, and it normally breaks down in favor of gold. So I'm always very interested in gold because I love trading gold. Let me see if I can find my tool here. I think that's the one I wanted. I hope I haven't missed a page anywhere. I might have. Let's see if it brings this back to life. Yeah, that was the one we had. So this is the next one we wanted. Have a look at this. This is the dollar dilemma. We can get a rough approximation of what markets are doing by the Daniel Code number that they hit. And the fact here that dollar, this is a 6-day chart, has topped out at that 96,770 Daniel Code level. That tells us that the dollar is actually only correcting a minor swing. It's not correcting the major swing that goes right to the January 16 high. So this market is inherently, on a long-term basis, is inherently weak. And the Trump administration wants it to be weaker. Mnuchin is pushing hard to keep the dollar weaker, of course, with the massive additional debt that the U.S. has taken on with its not only its welfare programs, but its military, but more especially the additional debt that's come from the latest tax package. The Treasury wants to see a weak dollar because that makes it a lot cheaper for them to pay down debt. And this dollar is showing some indication to be less than fully confident about it. The fact that it's only correcting a minor swing tells you on a long-term technical basis there's not any particular strength in this market. As opposed to that, have a look at gold. Now, bear in mind we switched from a 6-day chart to a daily chart. So they're not directly comparable, but I've done that on purpose because I want to show you the difference. Gold, the numbers that Gold Arc is using in its correction, and there's a whole stack from which are not all on this chart, but the Daniel Code number that it's using has elected on its way into this rally. It is correcting the major swing all the way back to the May highs. And this is a big deal because technically gold is in a much stronger position than the dollar. And gold is in a pretty good position to have a breakout. Now, I'm always amused by the writings that go on about gold. There's a stockade full of gold bugs. Most of them, not like Harold, who's a very genuine trader, but the vast majority of those guys are purveyors or sellers of bullion, and they have a vested interest in talking up gold. And we see that non-stop, endlessly, on and on it goes. Gold's going to, get rid of fiat currency. Gold's going to fly to the moon. Well, get rid of all sorts of things and our lives would be different, but it's not going to happen. Those sort of assumptions are just rubbish, but they roll them out all the time. And the most perennial story is they're all gold bulls because they're trying to give you a reason to buy bullion, which you don't need to do. You can manage all the gold in the world you want with a futures contract. But the fact is that on this chart, the levels, the Daniel Code levels that gold is choosing for its retracement are far, far more bullish than we're seeing from what the Daniel Code numbers are that the US dollar index is correcting. So there's a reasonably big chance, Harold, of getting a breakout in gold in the not too distant future. So here we are, folks. If you'd like to be able to do all these things, trade time, forecast market turns, be with the market all the time, you're most welcome to do a Daniel Code tutorial. If you want to be a super trader, email me, jneedham@thedanielcode.com, jneedham@thedanielcode.com. I've learned from Bill O'Reilly you've got to say that twice. Send me your phone number and country and location so I don't call you in the middle of the night, and I'll be happy to call you and talk about the opportunities doing a Daniel Code tutorial. Now, I should tell you, folks, that the fee is $7,500 because I get quite a lot of inquiry, but when I send them the blurb that says it's $7,500, unfortunately I don't hear from them again. So I know it's a lot of money, but I've never had anyone say it wasn't worth the money. In fact, big numbers of people have done a Daniel Code tutorial and said, look, I've made the tutorial fee many times over in my first few months of trading, but I think we have 6 slots still left before Christmas. If you'd like to, good Harold, get excited, mate. It's gold's a big chance for a breakout, a real breakout. Good to hear from your dad. Harold's one of our longest serving members. It's great to still have him with us. Yes, if you'd, I think we have 6 places left between now and the end of the year. If you'd like to do your Daniel Code tutorial, you can. It takes anywhere from 1 month to 7 or 8 months. Just depends how much time you've got to do the paper trading that I asked you to do once I've taught you how to trade time, which is the greatest gift of all. So do let me know. We'd love to fit you in, but I only have limited slots available towards the end of the year, but there's 6 there now, so grab them while you can. Free trials, we can arrange free trials to Trade Navigator for you, free trials at the Daniel Code. Pretty simple, just click on the banner. There's a banner at the website that says free trial. Click on that, away you go. Terry will fill you in and enable everything for you. This is the compliance statement, folks, which you always have to read. I'm anxious for you to read it, because if you don't know how to trade, you're going to get wiped out. That's the reality. People say that 90% of traders will lose their money in the first 3 months. My view is 99% of traders lose all their money in the first month. And that's because they don't know how to trade. And one of the few things when I started trading, being an attorney, I thought you could learn from lectures and books and a bit of practical experience. And the reality is you can't. Markets don't work like that. And you need somebody to teach you what they've learned themselves. Here's TomTom. Gold, 1424 to 1450 by December the 20th. Let me have a look at my chart, TomTom, and see if we can agree on that. GC, here we are, and 1240 to 1424 to 1450, 1424 to 1450. Yeah, gold. Well, I don't know what you're looking at, Tom. We're obviously 1424 to 1450. I don't know what you're looking at, but certainly yes. I can't quite track that on my chart, but you're bullish as well, I take it. Okay. It's very rare for me to be bullish on gold, I can tell you, but it certainly has the potential to have a serious breakout now. So that's it for the day, folks. Thank you very much for being with us today. Here's the soybean chart rocking along on its success signal. Thank you very much for being with us today. Mike, good to have you with us, mate. Like, good to have all of you with us, and I hope to see you at our next webinar, which normally it should be in 2 weeks' time. So for me, it's Friday at 11:30, heading towards midday. It's a beautiful sunny day. There's a real bite of summer. We'll be heading to the swimming pool, maybe in a couple of days if this warmer weather keeps up. That's how good it is down under. Thank you for being with us. I look forward to seeing you again next week. Any questions, shoot me an email, jneedham@thedanielcode.com, and I'll look forward to being able to assist with any questions at all. Bye for now.